Good morning and welcome to Headlam's 2021 year-end presentation. My name is Chris Payne, I'm the Chief Executive. This morning I'm going to talk to you about the 2021 performance and strategic update. And then we'll be talking about the dividend profile. I'm delighted to announce that we are also issuing a return to shareholders through a special dividend and also a structured buyback programme. And then we'll close the presentation with an update on our ESG strategy and a brief trading update of performance in the early part of 2022. So about us. So this is Headlam on a page, if you like. We've been operating in the floor covering sector for just over 30 years. We've got nearly 25,000 customer accounts across the UK and a little bit in Continental Europe as well. Predominantly those customers are small independent retailers and fitters. We do have some large customers within that group as well, and we'll talk a little bit about that customer segmentation later on. We have a comprehensive service offering across the UK, predominantly through the broadest range of stock holding that exists in the UK. We have 66 sort of selling organisations, if you like, and they're operating out of just over 20 distribution hubs and 53 trade counters. And again, I'll cover our ambition around growing the trade counter footprint later on. We have dedicated sales teams who sell those 66 brands. And we have an extremely strong, well-founded business with a good quality balance sheet and track record of delivering performance over those 30 years. We've been going through a business change strategy in the last couple of years, and we'll dwell on some of the detail in that section later on in the slides. We have identified some substantial growth opportunities for us as a business, and indeed we are targeting a growth in our operating margin. So the highlights for 2021, we've pulled out some bullet points on this slide, and on the right hand side we have shown the split of our revenue between the commercial part of our business and the residential part, and indeed the split between the UK and Continental Europe business. Now those have changed a little bit in the last few years. Typically they have been quite consistent over time. But for those of you who know Headlam, I've mentioned the slight drift towards residential market in the last couple of years, and we saw that certainly in 2021. Now that's born out of the fact that the residential market has been buoyant, and we've seen that in many parts of the sector. And that has meant that the typical sort of 2/3, 1/3 residential commercial split has moved a little bit towards residential, and we currently are at 68.5 and 31.5 in favour of residential. That's had an impact on gross margin. So we saw a revenue recovery in 2021 from a relative low point in 2020, which was heavily COVID affected. So we did have some closed operations in 2020. We were fully operational in 2021, hence the strong bounce back. And gross margin actually was relatively rich in 2021. So we've seen a sort of record 33% gross margin. Now that was helped by a couple of things. One was the price inflation that's been a feature of the marketplace over the last year. And secondly, this move towards the residential sector. And typically residential products for us that are smaller orders than the commercial space typically are at a higher margin. So that mixed benefit has also helped gross margin. But actually some of the factors that we've been following through in the change plan and the operational improvements that we'll cover later on have also helped the gross margin. So we have seen, therefore, an increase and a bounce back in our operating margins and well on the way towards the 7.5% target that we have referred to the market in previous presentations. So that's meant that our underlying profit before tax has really seen a strong bounce back, not quite at 2019 levels yet, and we've got a slide where we'll talk about the comparatives in previous years. There's a couple of points in here about the balance sheet, so net funds and average net funds, and we've got a real strong performance around cash. The generation of cash and the retention of cash this year has been particularly good, and we've ended up with a strong positive net funds position all year, and that's in contrast to what we've seen in previous years. As a result of that sort of strong cash position, we are proposing a couple of things. We are proposing a final dividend and also an additional distribution to shareholders, which I'll come on to in more detail later in the slides, but that will be in the form of both a special dividend and a structured buyback programme. So turning to the financial track record, these are comparatives against last year, and also we put on here 2019 because that was the year obviously pre-COVID. So we're able to compare and contrast our results that we've seen in 21 against 19. So just turning to the 6 key features that we've pulled out, we talk about revenue, we talk about profit, we talk about the dividend payments and also net funds on this slide. So I think what we can see is that the revenue has been a bit of a bounce back, but we haven't got back to 2019 levels yet, which has meant that the underlying profit, although is relatively close, does show that we are improving our operating margin as a result of that improvement in the quality of the earnings that we're seeing. We are seeing, therefore, a recovery in the EPS. Now, the EPS has also been affected by an increase in the tax rate since 2019, so we'll come to the income slide later on, but we have seen an increase in the effective tax rate between 19 and 21, which has held back EPS a little bit. Dividends, again, good news on dividends. We are announcing the final dividend and also the special dividend, which we'll come to in time. And this shows also the average net debt and the average funds that we've seen as a significant improvement in 2021 over previous years. Hence, has given us the confidence to return some of that surplus cash that the board has identified. So this is the daily sales chart, and we typically do spend a little bit of time talking about this chart with investors. And there's a couple of features here. One is obviously the big V shape that we saw in 2020, and I've talked about that before as a real strong bounce back and probably typical of what the Chancellor was hoping to see when he announced all of the furlough plans back in 2020. So we did see our business close during that period, hence the significant decline in revenue. But I think the other feature is that we have seen that strong bounce back, and the other lines, we've put on here 5-6 years worth of trading. So you can see a pretty consistent profile. And I also have included the trading update for 2022 on here. So January and February's line for 22 is on here, and I'll come back to that in a moment. But you can see that that has returned back to levels that we saw pre-COVID. So I think it does demonstrate this sort of consistent performance, albeit interrupted during 2020 and the early part of 21 as a result of some of the trading restrictions we saw during COVID. So just turning to an operational update and kind of a summary of our strategy. There are 4 things here I just wanted to pull out some sort of highlights. Now, these are the fundamentals, the building blocks behind our strategy. I'll come on to some of the growth opportunities and what we've been doing in the revenue side in a moment. But just sort of some of the features of operations. I think not surprisingly, much of the market, and in particular this sector, has been affected by the supply chain issues that we've seen. Now, whether that's because of the oil prices, whether that's because of raw material shortages, transportation difficulties, that has been a challenge for the industry. I'm pleased to say that we've been able to mitigate much of that. We've been able to handle the price increases that we've seen coming through from the supply chain, and indeed our inventory is actually up year on year. So that is evidence of us being able to manage through those supply chain difficulties really rather well. We have simplified our operations, and we talked in the past about the consolidation of our network and the consolidation of our delivery vehicles. That's been achieved. We have disposed of one of our businesses in Switzerland in year. So I think it just demonstrates that this sort of more efficient, consolidated operation is starting to take effect. We have embedded those change benefits now, so I think we are seeing where we are generating additional revenue, a higher return, and that's part of the reason why our operating margins are increasing. So we've got this more efficient operation that now supports the business. I'll come on to the ESG strategy towards the end of the presentation, but I think it's safe to say that we have seen a real focus following the publication of our first ESG strategy in May in 21. So we have seen a real focus and engagement, particularly with the supply chain around ESG developments. And as I said, I'll come back to those features later on in the slides. So all in all, operations in good shape to help us deliver the margin targets that we've stated in the market. So just coming on to revenue and growth and where we see the opportunity, this is a slide that I've shared in the past. And we did a bit of work to really understand the market and where much of the distribution turnover is spent. And we've identified these different customer types, some of which we're strong in. And I mentioned at the start the nearly 25,000 customer accounts that we've got, which tend to be towards the left-hand side of this slide in the traditional retailers and the independent fitters. But there are other big chunks of the market where we are typically quite underweight. And if you look to the right-hand side of this slide, I'm talking about the large house builders, the larger multiple retailers. And I've got some slides that talk about what we're doing to address those parts of the market where we're underweight. So this is a really exciting slide. We've got lots of opportunity to grow. And as market leader, it's great to be finding these opportunities for growth. So this is sort of strategy on a slide, if you like, and really summarises what we've been doing. And I think the top half of this page underpins and is the operational side of the change that we've been delivering. And then at the bottom, these are the sort of three main elements of growth that we're looking to generate in the next year or two. And I've got some slides which cover these in more detail, and I'll run through them. But in summary, I say we've got the operational efficiency, what we've been doing to develop brands and engaging with the supply chain. And then at the bottom, we've made some really good progress on trade counters, penetrating the large retailer section. And that's also helped, of course, by the digital and e-commerce investments we've been making. And I've got some exciting developments to talk to you about on those as well. So trade counters is the first one of those. We talked in previous presentations, which you may have seen, of a real ambition to nearly double the number of trade counters across the network. I say we've just got over 50 and we're looking to grow that up towards 100 in the coming years. We see this as a real point of difference for us. And in particular, during the COVID lockdown, many of our customers, as we all did in our home lives, really moved towards a sort of click and collect, this desire to transact online and then physically collect products from site. Now, we've only got 53 to cover the whole country. So clearly there is an opportunity for us to grow geographically. And not just that, we see an opportunity to grow the quality and content of each of the trade counters. So we've been working on a blueprint, many of which have been rolled out to new sites. Now, we've had some really good feedback and performance from the sites that we did in 2021. And the relative modest level of capital investment is one thing, but the real kind of investment is in blueprint and the quality of the people running those sites. So empowering the individuals who run the trade counters to be salespeople, to get out in their local markets and really offer great service to customers. We've seen an uplift and quite a significant uplift in the revenue from those sites that have been invested in. And when you compare those to the sites that have yet to receive the investment, you can really see the impact of both sales growth and, importantly, margin performance. So we've got great confidence that these trade counters that we are investing in and rolling out will generate that significant revenue growth that we are articulating. Now, it will take a number of years to get to, of course, because they take a while to mature, but certainly the evidence that we've seen on the sites that we have opened is that they are in line with our plans and accelerated the revenue that we were hoping to achieve. The next area of revenue focus is on the multiple retailers. Now, this is an area that, again, we've talked in the past from a sort of investment case perspective. Why does it make sense for a multiple retailer to work with Headlam? And it is worth dwelling on that and building on the features of Headlam as a business. As I said, we offer unrivaled stock holdings of range of product and suppliers and manufacturers. We can stock all of those here in our facilities. And therefore, we can offer a really compelling range and depth of service offering and stock holding to customers. And multiple retailers are particularly interested in that because we're able to offer that sort of UK-wide consistent service. We can curate ranges for them. And I think it also takes the sort of bulky, quite difficult to handle products out of their distribution network. And it means that we can offer a real professional, dedicated floor covering service to them. So very compelling offer. And what we've done here is that I've picked out as a case study, if you like, one of our new customers in this sector. And this is something that we're hoping to develop in the coming months and years. So Oak Furniture Land, well-known high street retailer, took the decision to work with us and put oak flooring into their showrooms. So that's early days. We've been running a trial with them. Their early feedback is that they're delighted with the performance that we've seen. The sites that have opened, their sort of flagship store in Cheltenham has made a number of sales since they opened in January. So we are seeing that as a great opportunity, good quality product, complementary with their existing service offering to customers. And they've also talked about the sort of halo impact that they get on sales of their other products as a result of having a really good looking kind of flooring setting in their store. So that's something that is really great for the customer, great for us, and we get the opportunity to grow into the future. So turning to digital and e-commerce, I mentioned earlier we've got the sort of exciting development, and this is the slide which covers the Headlam app. So something that we launched right at the end of 2021. Now this is an online portal for people to use and access their B2B accounts with whichever Headlam business they trade with. So it really gives them the ability to look at all of their accounts. They can transact, they can search for stock holdings, check prices, place orders. And they can even use the room visualizer that we've developed to share with their customers what the product might look like in the home. They're also able to do things like create customer invoicing and pricing from the app. So it's a real step forward for us in the industry. And certainly the feedback that we've had from customers has been extremely positive. And as I said, in a handful of weeks, we've been able to generate well over £1 million worth of sales through this new app. So it's exciting. And of course, further developments and launches of and upgrades to that app will come in time. And I think that's just one example really of the investment that we are making in the digital environment. I think in many respects, we as consumers get spoiled by the amount of sort of digital engagement you get, and B2B sometimes can be a little bit slower to market, but this is something that we are focusing on with our customers, developing special sort of packages to help with those large retailers in particular order from us electronically, place orders, and we are seeing a significant increase in the amount of digital orders we're taking. We're well on the way to achieving that 30% target that we set ourselves, and we were down, just as a comparison, we were down in the teens only a couple of years ago. So a real transformation in the amount of orders and engagement we are taking online. I mentioned products and brands. This is a big area of development for the group, and we have a number of consumer recognised brands in the marketplace, but arguably a little bit underinvested. So this is something that we have focused on, and we are investing a bit of marketing, a bit of tightening of what the brands mean. And the team in Tamworth who are responsible for these brands have done a great job of developing brand awareness and marketing collateral. We've launched new websites. And also we've developed a new brand together with British Wool called Wool Britannia, which is a sustainable flooring which uses wool as the surface and the top coat. So again, that's an exciting development. We've done that in combination with the marketing team at British Wool, so that gives us a real presence in the marketplace. It's something that we've been able to take to trade shows, and it's something that consumers will recognise and buy into. So this sort of sustainable part of product development is obviously important for us, and this is the start of a really I think exciting product development journey for us. Just turning to suppliers and what we've been doing in the buying space, I think one of the most pleasing aspects of the year is how we've navigated the challenges around the supply issues we've seen in the industry and in the sector. I mentioned at the start that we've had an increase in our stock holding. We've been able to mitigate the challenges with the supply chain, the raw materials, through engaging our suppliers and ensuring that we are working together to get good quality supply regularly into the business. So that's been a real success of the year. We've started to work with suppliers and talking about how do we ensure that we are working towards a sustainable agenda. So promoting sustainable flooring, helping manufacturers investigate and promote more sustainable methods of manufacture, and also some of the product development work that they're doing. We are engaging with them on how we can support sort of end-of-life recovery of flooring as well. So that's quite early days, and there's more of that to come, and I'll talk a little bit more about that in the ESG section at the end. We are engaging suppliers on ranging, and I mentioned having such a strong, deep set of products in our warehouses. And that's something that we're able to work with our kind of key relationship suppliers where we can focus on ranges and maybe even do more product in a deeper way with some of those key suppliers than having a scattergun approach to supply. So I think that's something that we are working on this year and will continue into the future. So really important that we have this strategic engagement with suppliers. And I think that's partly why we're able to mitigate the supply issues that we saw in 2021. So just turning to financials, I've got a handful of slides covering the financial performance for 2021. So we'll talk a little bit about the income statement, revenue, and then we'll move on to the balance sheet. So income statement for 2021, we can see the comparatives in here as well. So what we have seen is a couple of things worth picking out. We saw that really strong recovery in revenue following the COVID effective 2020. And as I mentioned at the start, although we haven't got 2019 on here, the revenue hasn't quite returned to 2019 levels. What we have seen, which is a fantastic performance, is the gross margin. I think a record 33% gross margin, which is a great performance, has benefited a little bit from the price inflation we've seen in the marketplace and this sort of positive mix effect that we've seen moving to residential product. But partly that also reflects the work that we've been doing with our suppliers to improve the quality of the product that we're buying, which is now reflected in margin. We've kept control over costs, which has meant that the operating margins have improved, well on the way to the 7.5% target that I mentioned earlier. Now, there have been some non-underlying costs again in the year, and I have a slide which will talk a little bit more detail about that, and in particular, the write-down of the stock and the property that we have at Kidderminster, the Kidderminster Distribution Centre following the fire towards the end of 2021. So just focusing on revenue, this is a slide that I do like to talk through because it bridges the revenue that we saw from 2020 through to where we ended the year in 21, and it breaks it down into the two key segments of the UK and Continental Europe, and also breaks down the growth and change between like-for-like, sort of underlying, if you like, sales improvement, changing working days, whether there's any effect of acquisitions or translation from the European business. So I won't talk through every number, but what it does show is that both the UK and the European businesses both bounced back strongly following the COVID affected 2020. And I think we have seen in both markets actually this sort of residential focus and people spending on their homes as a result of spending more time at home, I think, and the disposable income and the lack of availability of travel and other hospitality measures that they may have seen during 2020. So both markets performed very well, and we did actually lose a little bit of revenue through a reduction in working days. So just focusing on profit. So this is, again, a bridge that I like to talk to, which bridges 1 year's profit to the next and talks about the kind of key movements that we've seen during the year. Now, 2020 was affected by COVID, as I said. Now, the consequence of that was that we took some furlough money from the government during 2020. So that's obviously had quite a big impact on 21, where we've lost the benefit of that. But what we have seen as a result of the revenue growth is a really big improvement in gross margin, so £40 million worth of gross profit that came in. We were able to hold on to half of that, and that was through the sort of cost control that we had. And we did see an increase in people costs and variable costs, as you might imagine, to deliver that additional volume. But it did mean that we were able to see quite a significant turnaround in profitability and, importantly, an improvement in that operating margin that I mentioned earlier. Turning to non-underlying items, I mentioned the fire at Kidderminster, which was a very difficult situation at the end of 2021 in December. Thankfully, we knew very quickly that everybody was safe and got out of the building very quickly. However, I think perhaps one good thing that did come out of it, it did demonstrate how resilient our business model actually is. So within 4 days, we were able to deliver first customer orders to the customers at Kidderminster, and now that was achieved through a very resilient business model that we've generated, where the digital investment we've made in phones and systems and operations meant we could switch the phones over, change the trading to one of our other sites, and we're able to therefore deliver the stock and the customer orders, as I said, within 4 days. So fantastic achievement, and as I said, thankfully everybody's safe. What it did mean, though, of course, is that we had to write down the stock and the property at Kidderminster, and we've taken that as a non-underlying cost in the year. In other items, we have seen a continuation of the business restructuring costs, and I mentioned earlier that we have seen an operational efficiency move, and we've improved the quality of the operations. Now, that did need a little bit of change, and some people costs were taken in 20, carried on in 21, and that's now largely complete. So we shouldn't see any cost in 22. The other aspect was that we disposed of 2 freehold buildings that were surplus requirements following the opening of the Ipswich facility that I've talked about in the past. And those 2 facilities were sold during the year and made a gain, which we've obviously also taken through non-underlying items. So just turning to cash flows, and we have seen typically a really strong performance in cash. Now this year, a little different. Interestingly, we have seen the sort of unwind, if you like, of the working capital effect of the COVID lockdown. Now this is, I'll try and explain how the numbers work here, but in 2020, we did see quite big cash inflows as the business was contracting through the COVID experience, and we saw big cash inflows through a reduction in working capital. That's now unwound, as you might imagine, as we've ramped the business back up. And the sort of inflow that we saw in 2020 pretty much matched by the outflow in 2021. So a bit of a normalization effect going on in working capital. We have seen some receipts coming in through the disposal proceeds of the freehold properties that I mentioned just now, and indeed the disposal of the Swiss business. So we have seen a strong sort of in and outflow on working capital between the 2 years, but we ended up with a positive movement on cash at the end of 21. Balance sheet, mentioned this before, mentioned it right at the start. It's a key feature of the business, is a really strong, well-founded, well-invested business, strong balance sheet. We own our own freeholds at our distribution centres, hence the disposal of the freeholds I mentioned earlier. So that you can see that in a very strong balance sheet, a good inventory position, which is up on last year. And the other thing just to note is that we did renew and refinance our banking facilities just after the year end. So in January, we were able to really go for a much longer tenor. And the great news is that we've now got facilities out to October 26 with a year extension as well. Now, clearly, we've got a very strong net funds position at the moment. So we'll talk a little bit about the sort of surplus cash return to shareholders shortly, but it does show a very strong balance sheet. Just tracking the funds position. This is a slide that we started to use a little while ago, and shareholders like to see that the sort of pattern of funds and net funds as we go through the year. You can see that we've now moved away from the sort of half year and full year spikes that you tended to see, and I've talked about that in the past, of my desire to move to a more smooth payment stream to suppliers and receipts, and we've achieved that. And you can see this sort of steady recovery in net funds from the middle of 2020 as we really focused on liquidity. And we've been able to hold on to that position throughout 21, and that's what's led to the real positive net funds and the turnaround in the net funds performance over the last couple of years. And I think that is testament to the strength of the business and the way in which we've managed and controlled the overall business. So I think that sort of strong funds position and that continued strength of the balance sheet has led us to review the capital allocation priorities. And the great news is that we've been able to identify that there is surplus cash and go through a return to shareholders. So just running through this slide in a little bit of detail, we did clarify our capital allocation priorities last year, and we published those in the reports and accounts. And as you run through this, yep, we've got a strong balance sheet, and that's a tick, and I've just talked through that. We are making some investments in the business, and we are ramping up that investment in the trade counters, as I talked about. We are refreshing the MHE and replacing some of the equipment that we've had at many of the sites for many years. Despite that, then, we've then made the sort of return to the dividend payment stream and twice covered on ordinary dividends, so we're able to announce that this year. The last two then priorities for us are around looking at sort of potential M&A opportunities. Now, although that may not be something that we're looking at imminently, there may well be something coming downstream in time. So we need to keep a little bit of our capital and our firepower available for potential future investments. But despite that, we have identified that there is a sort of surplus cash and our ability to return £30 million of that to shareholders. And we're going to do that in two ways. One is to announce a special dividend, which will be paid in line with the ordinary dividend. And that will be £15 million of that. And that works out at just over 17 pence per share. And that's in excess of the total dividend payment that we're making and announcing for 21. So it's a really doubling up of that dividend. And that also means, therefore, we've got enough left and we're looking to enter into a structured buyback program with our brokers, where we'll be investing a similar amount of of cash, £15 million in a buyback plan, which will obviously take a number of months to run. We think that may take up to 12 months to run, but it's a real strong statement from the board that we've got a real strong business and confidence in the future. Turning to ESG strategy, I promised a sort of summary of the ESG actions that we've taken over the year. So we've got a slide just summarising some of those points. We did produce our first full form ESG strategy in May, and this year we're going to publish that alongside and as part of our annual report, which is due out in the next few weeks. So what have we been doing? I think it's worth dwelling on the fact that ESG is E and it's S and it's G. And as a listed PLC, you might imagine we've been very strong on governance. And the compliance activity in the market obviously continues to go, and it's something that we have to keep under watch always. But I think the areas that we've really focused on this year are around the S, the social kind of side of our business and supporting local communities. And that's something that we're going to be really focusing on 22, is supporting the communities we operate in. And there's a community programme I'm working on with my colleagues, which will provide sort of charitable support and community engagement across the whole of the businesses that we serve. And then turning to E, so the environmental side is typically what people do think about when we mention ESG and the sustainability side of our business. And there's an awful lot of actions that we are taking in that area, so much so that we're going to create an ESG committee for 2022 that can focus on tracking the performance of the actions that we're looking at. We've just launched a diversity, equity and inclusion programme, and we're looking at capturing the views of our people in the business to see how we can focus on that for 2022. And I think this sort of ongoing supplier engagement I mentioned earlier around this sort of end-of-life recycling, capturing that product as it comes back when it's removed, is something that we will continue to talk to our suppliers about. Now that might take a number of years, but it's important that we are part of that sort of industry response to this important issue. And then I think the last thing just to mention is that we have set ourselves an ambition of going net zero on carbon by 2035. And of course, we'll take some time to work out the actions that we need to take around scope 1, scope 2 and scope 3, of course, in the coming months and years to work towards that ambition. Just bringing us right up to date with trading update for January and February and the outlook. And also one or two board changes that we've seen. So I'm delighted to announce that I've been appointed as Chief Executive for Headlam, which means I'll be immediately looking for a CFO to join me on the board. And also the chairman has announced that he's stepping down after the AGM. So I'd personally like to thank Philip Lawrence for all of the work and support he's given me personally. And on behalf of the board, I'd like to thank him for his efforts, what's seen us through a real transformational period over the last few years. So just turning to trading update, you will have seen on the daily sales chart that I did put January and February sales numbers on the slide. So we have seen a good recovery back to pre-COVID levels. So that's a solid start to the year. And we've seen some early signs of the growth opportunities that we talked about through trade counters and the independent retailers really starting to take hold. So that's given us confidence on the outlook for the year, and I think the strategy is going to deliver that strong performance for the year ahead. Against that, we do have to say that there are some headwinds, and many people have been talking about inflation impact in the market. There's the supply chain issues, which we have mitigated. But this sort of effect on consumer spending is a little unknown. So I think that is a cautionary note in the outlook. But as I said, a good start to the year, and the strategy that we've got gives us some confidence for the outlook. So that brings us to the end of the presentation. Thank you for joining, and I look forward to taking questions.
And we've got a question here. Do you think the residential sector strength will continue, i.e. home improvements, etc.?
Yeah, I think there's a couple of competing factors on that particular question. I think there is, undoubtedly on the positive side, I think the people investing in their houses has continued. They have strong wage inflation, they have high employment, so perhaps there is going to be a continuation of the strong residential spend. But I think the obvious headwinds that we've seen and the whole industry and the whole of the UK market is facing into this. Inflation and heat, light and power costs, fuel costs, and I think that sort of headwind and challenge that's going to present itself in Q2, Q3 is going to perhaps put a bit of a handbrake consumer spending, but who knows? I think the other aspect there is that perhaps people will wish to travel this year. They've not been able to do that really over the last year or two. So perhaps we're going to see a slowdown on spend on that side. So I think there are a couple of competing factors, hence our desire to make sure that we can offer counterweight growth in other areas where we've had low share in the past. So I think it's important that we continue to look at the multiple retailers and the house builders to offset any potential slowdown we may see in our independent retailers on the consumer side.
Thank you. And in the market segments that you're underweight in, what's the competitive landscape look like, and who are the main competitors?
Yeah, it's an interesting one there. So if you look at the multiple retailers, for the most part, they actually buy their products direct from manufacturers. But as a consequence of that, it's quite a challenging service proposition for them. So they're able to buy a relatively low price. However, they have to take bulk supplies, they have to handle the product in their own distribution network, and they're quite awkward products to hold and distribute. So I think the proposition that we've positioned in that space is one that where we sit in between the manufacturers and that customer group. So that does mean that the multiple retailer will pay a premium over their direct supply from manufacturer, but of course in return they get a much better quality bespoke service. We can range broad ranges of products, we can bespoke it, we can give them their own branding, and we can package it up for each of their stores. So it can be a much more compelling service. We defray all of that working capital exposure that they have. And albeit it comes at a slight premium over their direct to manufacturer pricing.
Great, thank you very much. And can you expand on the reference to 1 billion customer segment in multiple retail?
Yeah, when we looked at the marketplace, and we did some work with a third party to look at the market and the sizing, we looked at, say, a £3 billion market is what we think the market's worth at distributor sales pricing. And that sort of breaks into the different customer segments. And the right-hand side of that chart that I put up is where that £1 billion sits. So we think £1 billion of the three sits in the multiple retailer and house segment. So that's quite a big chunk of the marketplace, and typically and historically we've had little exposure to that space, and therefore it seems to me and us that we can offer a really compelling proposition to target growth in those underweight areas.
Thank you. And can you explain what you're going to do as CEO differently in the future?
Yeah, I think the number of priorities I've been focusing on, I think for me there's a kind of market phasing growth aspiration. Operations, there's a bit of work to do there. We'll tidy it up. But for me, it's about injecting growth and energy and enthusiasm and targeting, really sharpening up our proposition and looking at growth in these new spaces. So for me, that's about energy, getting out, meeting customers, and adding some real kind of aspirational growth to that side. I think on the other aspect of it is engaging with our people. So I think we haven't been necessarily as hardwired and communicative with our people as we could have been, and I really personally want to see us invest in our people. We've announced a number of things where we've improved the reward packages for our people, sick pay and holiday pay. All of that stuff has improved in recent months, and I think that's something that I'm committing to in the future, of really engaging directly with the people who work for us.
Thank you. And how should we judge your level of success in penetrating the multiple retailer channel?
Yeah, it's something I think we need to continue to talk to the market about. Having now set out on this strategy, we talked about the size and the scale of the opportunity. I'd like to just keep telling the market about what we're doing, how successful we're being, and introducing, if I get permission to, the names of the customers we're working with. So I think that's an area that I'd like to see us growing in, and I'll just keep the market updated on how successful we're being, and to hopefully be able to drop in some customers that we've won.
And has staff been an issue, and staff attrition and attracting good staff, or have you managed to hold on to people and you haven't really needed to recruit?
No, I think the whole market has seen a bit of rotation and a bit of change, and people wanting different things out of life following the sort of COVID experience. So for me, it's about making sure we're a good place to work. We offer the right package, the right rewards, and I think the people that I talk to every day enjoy working in the business. So yeah, I think there are always some types of jobs where you will see a bit of rotation, but nothing. We haven't seen anything completely out of kilter with what we've seen in previous years. I think there's been a slight increase probably in 21 in a response to the lack of movement in 20 during the COVID period. But it feels like a good place to be, and people are enjoying working here.
Thank you. And what percentage of product is sourced from China?
Yeah, I mean, the Asian supply chain has been heavily affected by the cost of containers, and that's been a feature of the marketplace. Most of our product is UK and Western Europe supply, so we have single digits coming from Asia. So yeah, relatively modest, but obviously it has a bit of an impact around the whole world, doesn't it? When the cost of containers and the supply of goods from Asia does affect manufacturing processes in Western Europe. But say the vast majority of our product comes from Western Europe and the UK.
Thank you. And does new house building, which seems to be extensive at the moment, help your business?
Yeah, well, that's a good question, and timely, talking about strategy that I've just outlined. So in the past, we would have said no. I think how people moving houses and housing transactions typically hasn't had a bigger effect on our business, because when people move, they tend to refurb and change the rooms, and not just one room. They may do a whole floor or the whole house when they move home. So we have seen housing transaction as being important, and therefore the number of house builds has been less relevant, because in any given year there may only be a couple of 100,000 new houses being built, whereas we've got established dwelling numbers in 20 million and some. So the RMI spend has been a far bigger factor for us. However, if we are targeting house building as a sector, and we've got quite a compelling proposition in that space, clearly the number of house builds that are being made is important to us. And it's encouraging to see that the number of house builds in 21 is around 25% up on 2020. And the expectations are that 22 will be even higher. So I think we're addressing this market at the right time. And the proposition that we can put to that market space is encouraging. So yeah, I think house builds will be increasingly important for us as we develop that part of the business.
Thank you. And can you talk a little bit about cost inflation and the effect it could have broadly or specifically on the residential sector?
Yeah, as I said at the start, what does the residential and consumer demand curve look like? No doubt cost inflation will have an effect on that at some point. As I said, the flip side of that, of course, is that wage inflation is compensating for that, and the level of employment also. So on us specifically, the cost inflation obviously does have an effect. Heat, light, power and fuel is embedded in our cost to serve. I suppose in our sector there has been price inflation on the product supply. So that price inflation typically gets passed on to customers, which means that we can accommodate some of the cost inflation we've seen further down the income statement. But as I said at the start, I think the bigger question on cost inflation is what it does to demand generally. And I think there's a little bit of protection in our sector because of the infrequent timing of when consumers actually replace their floors.
Tremendous. Thank you very much indeed. And that's the end of questions. Do you have any closing remarks?
Yeah, I think I said at the end of the slideshow, there is this sort of headwind that we're all facing into on the consumer side, but I think we're well placed to meet that. We've got a great strategy. It's showing some good, solid early performance and signs in January and February. The sort of stretching out into different parts of the customer types is going to only add as a counterweight to any weakness there may be. So yeah, board's really supportive and confident in the future. So we're hopeful for a strong 2022.